America's rising debt raises significant concerns, as it reveals a troubling trend of raising the debt ceiling without adequately addressing existing liabilities. This cyclical pattern undermines financial stability. Should the U.S. default on its debt, the repercussions could extend globally, given that a substantial portion of international trade relies on the dollar. The ramifications would resonate across the world. The origins of America's debt can be traced back to the Revolutionary War, when bonds were issued to finance expenses, establishing a precedent for borrowing to meet financial needs. This borrowing pattern has persisted through the decades. The U.S. government consistently borrowed funds to pay bondholders, resulting in an increasing national debt and persistent annual budget deficits. This cycle continued well beyond the conclusion of the war. The introduction of taxes to address war expenditures incited considerable unrest, culminating in the Whiskey Rebellion, where farmers protested against the whiskey tax. This event underscored the tension between the government and its citizens. Despite the challenges posed by the rebellion, the federal government's response showcased its authority and ability to enforce laws, bolstering public confidence in the new nation. This marked a pivotal moment in the establishment of federal power. The national debt surged significantly during the Civil War, reflecting the financial strain imposed by the conflict in the 1860s. By 1866, the debt escalated from $65 million to an astonishing $2.76 billion. In 1917, Congress introduced the debt ceiling to simplify borrowing processes amid World War I, granting the federal government increased financial autonomy. This change represented a fundamental shift in fiscal policy. World War II prompted another dramatic increase in the debt ceiling, which skyrocketed from $42 billion to $258 billion. This substantial borrowing exemplified the relentless financial pressures faced by the U.S. during wartime. Currently, the U.S. economy is heavily reliant on debt, with a ratio of 123% of GDP. Regular adjustments to the debt ceiling are essential to uphold economic stability. A default would erode confidence in the U.S. dollar, which constitutes 60% of global foreign reserves. This scenario could initiate a worldwide economic depression, affecting numerous nations. To avert a default, the U.S. has several avenues, including negotiations with Congress or invoking the 14th Amendment. Each of these options presents inherent risks and uncertainties for the economy. Meeting financial obligations without congressional approval underscores the urgency of fulfilling interest payments on bonds. This aspect is vital for maintaining trust in the economic system. The perceived stability of the economy hinges on hope and trust, as the foundation often seems more like an illusion than a robust structure. This situation raises critical questions about the future of global economic stability. The debt-to-GDP ratios of both the US and Japan expose a wider issue among affluent nations, challenging the conventional understanding of what defines rich countries in an era characterized by soaring debt levels.